My question is, where do you want to go fishing for the next 3 to 5 years? Which sectors are you most bullish on, and which sectors are you most bearish on? Thank you.
Yeah, Charlie and I do not really discuss sectors much, nor do we let the macro environment or thoughts about it enter into our decision. We're really opportunistic, and we obviously are looking at all kinds of businesses all the time. I mean, it's a hobby with us almost, probably more with me than Charlie. But we're hoping we get a call, and we've got a bunch of filters, and I would say this is true of both of us. We probably know in the first 5 minutes or less whether something is likely to or has a reasonable chance of happening. And it's just going to go through there, and it's going to. The first question is can we really ever know enough about this to come to a decision? And that knocks out a whole bunch of things, and there's a few, and then if it makes it through there, there's a pretty good, reasonable chance we may do something, but it's not sector specific. We do love the companies, obviously, with the moats around the product, where consumer behavior can be perhaps predicted further out. But I would say it's getting harder for us anyway, to anticipate consumer behavior than we might have thought 20 or 30 years ago. I think that's just a tougher game now. But we'll measure it, and we'll look at it in terms of returns on present capital, returns on prospective capital. A lot of people give you some signals as to what kind of people they are, even in talking in the first 5 minutes, and whether you're likely to actually have a satisfactory arrangement with them over time. So a lot of things go on fast, but we know the kind of sectors we kind of like to, or the type of business we kind of like to end up in, but we don't really say we're going to go after companies in this field or that field or another field. Charlie, you want to?
Yeah, some of our subsidiaries do little bolt-on acquisitions that make sense, and that's going on all the time. And of course we like it. But I would say the general field of buying whole companies, it's gotten very competitive. There's a huge industry of doing these leveraged buyouts. That's what I still call them. The people who do them think that's a kind of a bad marker, so they say they do private equity. It's like making the janitor call himself the chief of engineering or something. But anyway, the people who do the leveraged buyouts, they can finance practically anything in about a week or so through shadow banking, and they can pay very high prices and get very good terms and so on. So it's very, very hard to buy businesses, and we've done well because there's a certain small group of people that don't want to sell to private equity, and they love the business so much they don't want it just dressed up for resale.
We had a guy some years ago came to see me, and he was 61 at the time, and he said, "Look, I've got a fine business. I got all the money I can possibly need." But he said, there's only one thing that worries me when I drive to work. Actually, there's more than one guy that's told me that's used the same term. He said, there's only one thing that bothers me when I go to work. If something happens to me today, my wife's left. I've seen these cases where executives in the company try to buy them out cheap, or they sell to a competitor and all the people. He says, I don't want to leave her with a business. I want to decide where it goes, but I want to keep running it. And I love it. And he said, I thought about selling it to a competitor, but if I sell it to a competitor, their CFO is going to become the CFO of the new company, and they're, on down the line. And all these people who help me build the business, a lot of them are going to get dumped, and I'll walk away with a ton of money, and some of them will lose their job. He said, I don't want to do that. And he said, I can sell it to a leveraged buyout firm who would prefer to call themselves private equity, but they're going to leverage it to the hilt, and they're going to resell it, and they're going to dress it up some, but in the end, it is not going to be in the same place. I don't know where it's going to go. He said, I don't want to do that. So He said, it isn't because you're so special. He says, there just isn't anyone else. If you're ever proposing to a potential spouse, don't use that line. I mean, but that's what he told me, and I took it well. And we made a deal. Logically, unless somebody has that attitude, we should lose in this market. I mean, you can borrow so much money so cheap, and we're looking at the money as pretty much all equity capital, and we're not competitive with somebody that's going to have a very significant portion of the purchase price carried in debt, maybe averaging 4% or something.
And he won't take the losses if it goes down. He gets part of the profit if it goes up.
Yeah, his calculus is just so different than ours, and he's got the money to make the deal. So if all you care about is getting the highest price for your business, we are not a good call. And we will get some calls in any event, and we can offer something that wouldn't call it unique, but it's unusual. The person that sold us that business and a couple of others that actually it's almost word for word the same thing they say. They are all happy with the sale they made, very happy, and they have lots and lots and lots of money, and they're doing what they love doing, which is still running the business, and they know that they made a decision that will leave their family and the people who work with them all their lives in the best possible position, and that's in their equation. They have done what's best, but that is not the equation of many people, and it certainly isn't the equation of somebody who buys it and borrows every dime they can with the idea of reselling it after they maybe dress up the accounting and do some other things. And but when the disparity gets so wide between what a heavily debt financed purchase will bring as against an equity type purchase, it gets to be tougher. There's just no question about it, and it'll stay that way.
But it's been tough for a long time, and we've bought some good businesses.
Yeah. Okay, Andrew?
Warren, this comes from a shareholder who I think is here, who asked to remain anonymous, writes, 3 years ago, you were asked at the meeting about how you thought we should compensate your successor. You said it was a good question, and you would address it in the next annual letter. We've been patiently waiting. Can you tell us now, at least philosophically, how you've been thinking about the way the company should compensate your successor so we don't have to worry when the pay consultants arrive on the scene?
Yeah. Well, unfortunately, at my age, I don't have to worry about things I said 3 years ago, but this guy, obviously much younger, remembers. I'll accept his word that I said that. There's a couple possibilities, actually. I don't want to get into details on them, but you may have, and I actually would hope that we would have somebody, that's already very rich, which they should be, been working a long time, and have got that kind of ability, that's very rich, and really is not motivated by whether they have 10 times as much money as they and the families can need, or 100 times as much. And they might even wish to perhaps set an example by engaging for something far lower than actually what you could say their true market value is. And that could or could not happen. I think it'd be terrific if it did, but I can't blame anybody for wanting their market value. And then if they didn't elect to go in that direction, I would say that you would probably pay them a very modest amount and then have an option which increased in value or increased in striking price annually. Nobody does this hardly. The Graham Holdings has done it. The Washington Post Company did a little bit, but would increase because, assuming that there were substantial retained earnings every year, because why should somebody retain a bunch of earnings and then claim they've actually improved prove the value simply because they withheld the money from shareholders. So it's very easy to design that, and in private companies, people do design it that way. They just don't want to do it in public companies because they get more money the other way. But they might have a very substantial one that could be exercised, but where the shares had to be held for a couple of years after retirement, so that they really got the result over time that the majority of the stockholders would be able to get and not be able to pick their spots as to when they exercised and sold a lot of stock. It's not hard to design, and it really depends who you're dealing with in terms of actually how much they care about money and having money beyond what they can possibly use. And most people do have an interest in that, and I don't blame them. But I don't know, what do you think, Charlie?
Well, one thing I think is that I have avoided all my life compensation consultants. To me, it's sort of, I hardly can find the words to express my contempt.
I will say this, if the board hires a compensation consultant after I go, I will come back.
Mad. So I think there's a lot of mumbo jumbo in this field, and I don't see it going away.
Oh, it isn't going to go away.
Yeah.
No, it's going to get worse. I mean, if you look at, the way compensation gets handled, everybody looks at everybody else's proxy statement and says we can't possibly hire a guy that hasn't been.
It's ridiculous.
So on, and the human relations department, work for the CEO, come in and suggest a consultant. What consultant is ever going to get another assignment if he says you should pay your CEO below down in the fourth quartile because you're getting a fourth quartile result? I mean, it just, it isn't that the people are evil or anything. It's just the nature of the situation. Just it produces a result that is not consistent with how representatives of the owners should behave.
It's even worse than that. Capitalism is the golden goose that we all live on. And if people generally get so they have contempt for it because they don't like the pay arrangements and the system, your capitalism may not last as well. And that's like killing the golden goose. So I think the existing system has a lot wrong with it.
I think there is something coming in pretty soon. I may be wrong about this, where companies are going to have to put in their proxy statement the CEO's pay to the average pay or something like that. That isn't going to change anything. I mean,
It won't change a thing.
It won't change a thing, and it'll cost us.
And by the way, it won't get any headlines either. It'll be tucked away.
It'll cost us a lot of money, with 367,000 people employed around the world, and I mean, we'll hope to get something that makes it somewhat simpler so we can use estimates or something of the sort. But to get the median income or whatever, however the rules may read, and
that's what consultants are for, Warren.
Yeah, it is human nature that produces this, and I write in this letter to the managers every 2 years. I said the only excuse I won't take on something is that everybody else is doing it. But of course, everybody else is doing it is exactly the rationale for why people did not want to count the cost of stock options as a cost. I mean, it was ridiculous. All these CEOs went to Washington, and they got the Senate, I think, to vote 88-9 to say that stock options aren't a cost. And then a few years later, that it became so obvious that they finally put it in, so it was a cost. It reminded me of Galileo or something. I mean, all these guys.
Worse. It was way worse. The Pope behaved better to Galileo than he was.
Anyway, I would hope, like I say, somebody, whoever, and it doesn't even have to be, I'm not talking about the current successor or anybody else. I mean, these successors down the line are probably going to have gotten very, very wealthy by the time they're running Berkshire, and the incremental value of wealth gets very close to zero at some point, and there is a chance to use it as a different sort of model. But I don't have any problem if it's a system is devised that recognizes retained earnings, I've never heard anybody talk about it. At the 20 boards I've been on, or if you and I were partners in a business, and we kept retaining earnings in the business, and I kept having the value to buy a portion of you out at a constant price, you'd say this is idiocy. But of course, that's the way all the option systems are designed, and it's better to be for the CEO and for the consultants, and of course, usually if there's some correlation between what CEOs are paid and what boards are paid. If CEOs were getting paid at the rate that they got paid 50 years ago, adapted to present dollars, director pay would be lower. So it's got all these built-in things that, to some extent, sort of kindle the.
No Berkshire director is in it for the money.
Well, they are. They own a lot of stock, and they bought it in the market, just like this.
Yeah. No,
shareholder did.
It's a very old-fashioned system.
I looked at one company the other day, and 7 of the directors had never bought a share of stock with their own money. Now they've been given stock, but not one of the. I mean, I didn't say not one. 7 of the directors had never actually bought a share of stock, and there they are, making decisions on who should be CEO and how they should be paid and all that sort of thing. But they've never felt like shelling out a dollar themselves. Now they've been given a lot of stock. It's we're dealing with human nature here, folks, and that what you want is to have a system that works well in spite of how human nature is going to drive it. And we've done awfully well in this country in that respect. I mean, American businesses overall has done very, very well for the Americans generally. But not every aspect of it is exactly what you want to teach your kids.